Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Fertilizers Jazz is back after New Year holidays in 2025 and I'm glad to see you all again. Today is January 13 and it is a weekly markets update. Actually update for the two last weeks. Let's have a look at the news of week 2 and see what are the next trends. There are a lot of news to discuss today. These weeks were very active, I would say surprisingly active, taking into account that most of the markets were celebrating Christmas and then New Year. Urea market was the most vivid one, of course, and there are several key reasons for that. First, Indian urea tender that closed before the new year was unsuccessful, even scrapped, I would say, due to mistake in the proposal for the East Coast that resulted in purchase of only 187,000 tons to the West Coast at the price of $370 CFR. So it was clear to the market that India will retender very soon, and this anticipation fueled uncertainty about market balances in Q1 and prices respectively. Indeed, on Saturday last week, India issued the fresh tender for the same 1.5 million tons that it was looking for in the previous tender, 1 million tons for the West Coast, 500,000 for the East Coast. Shipment is required before March 5. The tender will be closed on January 23. This is unusual that India is competing for significant volumes in Q1, so traditional suppliers to India, Middle East and Russia will be focused on these shipments. And as a result, buyers from other markets will need to compete and thus pay higher for other origins that will be available. Clearly, Egypt was leading the price rally. Since the last week of 2024 until now, the average price at FOB basis in Egypt surged by 9%. Latest deals were conducted at the level as high as $430. At least 34,000 tons of granular product and 15 more thousand of prilt from Egyptian producers were sold last week. Key destination are European markets, which start to wake up and look for product. While some of these markets are hesitant to purchase now due to high prices, these are mostly southern European markets like Bulgaria, Romania, as well as some Central European markets. Other large buyers already started active purchases, like Italy and France to a certain extent. So, in upcoming couple of weeks, buying activity in Europe is expected to increase, because now it is obvious that not only February supply will be tight, but even half of the March supply as well. Other African producers also moved price tags higher. Algeria was selling at similar level with Egypt, Nigeria around $360 FOB. In Ethiopia, EABC closed its tender for 150,000 tons of granular urea on Wednesday last week, receiving offers around high 380s FOB Middle East. The loading should start mid-January and last until mid-February. Black Sea producers sold in the range of $380 to $90 FOB and even higher. Middle East producers fixed deals in the range of $375 to $80 FOB. Clearly, the values will be corrected further upwards together with general market dynamics. Another major problem for the international market now is Iranian exports cut. Last week, Pardes limited its production to one line only, and it will be fully sold domestically. There is no confirmed information regarding potential production restart, but market sources expect that stoppage this year will be longer than in previous years and might easily continue into February. This will most significantly impact Turkey, where demand starts to revive already and that will need to find another sources for imports, which usually happen massively in January, February to mid-March. In the US, barge prices surged, and especially for March, when the main demand is expected to arrive. March barges were sold already as high as $363 to $4 per short ton level. In Brazil and Argentina, there is no active demand now. Nominal prices increased, of course. The only active sales took place in the Central America last week, where Incofe closed a tender purchasing Russian granular and prilt product, almost 20,000 tons each. Granular price is understood to be around mid $410 CFR and prilled around $400 CFR. No surprise that paper values skyrocketed. Egypt FOB increased to an average $416 for January and February and to $398 for March. NOLA values jumped to the average of $346 per short ton for January, $351 for February, and $361 for March. Arab Gulf FOB climbed to the average of $375 for 2 months ahead. Brazil CFR for January increased to $370 and for February and March to $375. Ammonium sulfate buying activity starts to revive, but market pricing hasn't yet followed the rally in urea. Prices remained largely similar to the pre-holiday level. Standard product price in China remained more or less stable at the level of $132 to $35 FOB. Granular product price firmed slightly to the level of $145 to $55 FOB, amid increased demand from Central America, not from Brazil though, as well as strong demand from Turkey. During January, about 8 cargoes are expected to arrive to Turkey, both old agreements and fresh spot sales. In Central America, IMCOFE announced 2 tenders with several shipment options for about 35,000 tons of standard and 15,000 to 17,000 tons of compacted product. The tender will close tomorrow, delivery required between February 15 to 25. In Europe, activity returns to the market very slowly. German producer Domo increased prices by €15 to €269 FCA for January. Otherwise, price level in general remains mostly the same. In the US, prices jumped. The main producer, Interoceanic Corporation, revealed its second quarter prices, which are $10 higher versus Q1 for all locations. However, upward price correction in ammonium sulfate segment is expected soon. One of the additional factors is ammonium chloride industrial production. There is information from the market that China has extended the custom clearance for ammonium chloride from 30 to 40 days now, in order to control exports to have availability domestically for local NPK production. If that is really the case, then it will help sulfate prices to move up. Ammonium chloride has higher nitrogen content, but buyers may have to substitute it with sulfate at the end of the day. Nitrates prices in Europe surged. That was widely expected, due to gas price increase as well as urea price rally. Yara increased prices by 18 to 38 euros per ton. Other producers followed. In France, ammonium nitrate is offered at 425 euros CPT. In Germany and the Benelux, CAN is offered at 335 euros per ton CIF. In the UK, CF Industries also issued new prices for February and March, which marked from 5 to 10 pounds increase per ton. In Bulgaria, Neohim has stopped ammonia, ammonium nitrate and nitric acid production for maintenance and technical repairs last week. In Ukraine, importers continue active preparation for the season, while large domestic buyers activated domestic tenders. During past week, about 10,000 tons of nitrate arrived of Uzbekistan, Kazakhstan and Polish origin. More than 13,000 tons of nitrate were tendered by domestic buyers for delivery through mid-February. Still, the main demand hasn't arrived yet, and it is expected to appear in coming weeks. Same as for European UAN demand, which hasn't emerged yet, and most of the storage facilities are full at the moment. Still, prices in France increased following general trend in nitrogen. At NOLA in the US, prices also increased by almost $8, as well domestic prices across all locations. More than 230 tons of imported product is expected to arrive to US in January as a preparation to the main application season. In ammonia market, prices continue decreasing amid improving availability and decreasing demand. In Europe, prices dropped to $595 to $600 CFR with no fresh spot deals registered. In the Middle East, price corrected downwards by $7 amid good coverage of the buyers through February, as well as due to full-scale production of key regional producers. In India, price level dropped even more, by $17, because of weak demand of end users. And this happens despite there still will be quite a significant need in ammonia for DAP production in India, at least before mid-March. The US market remains in off-season mood with non-existing demand for short-term deliveries, and prices remain unchanged. In phosphate, situation in the market is mostly stable, while suppliers are trying to cover the gap left by Chinese product. India entered 2025 with DAP stocks lower than 1 million tons, which means they will have to buy more. The question is from whom, as China is out of action. There is no information about any concluded agreements with Moroccan or Russian producers that were in the air before holidays. DAP prices in India are stable. Last week, IPL purchased 30,000 tons cargo at $633 CFR from Ma'aden for January loading. The government also extended the special package for DAP, perhaps taking into account how low stocks are. Last week, Ethiopian ABC received revised bids, mostly in the $630 to $35 FOB range, with product originating from Egypt, Saudi, Jordan, and Russia. In total, bids made 400 to 480,000 tons in 8 cargoes. However, it is unclear if they are going to buy. There are rumors circulating that ABC will retender instead. In Europe, the activity is almost muted, now due to off-season. Brazil MAP appears to still be stable at $635 CFR. There was no recent buying activity. Trade data showed a 19% drop in MAP imports year over year. Farmers are looking for alternatives in SSP, TSP, and try to get nitrogen from other products. In the US, buying activity was quite significant, on the contrary. DAP barges traded for January at $580 to $83 per short ton, up by several dollars from a week ago. Importers are preparing for the season, and inventories are tight. There were several other market news announced last week that I think are important to mention. First, Turkish government announced its export quotas policy for 2025 for all products. And, not surprisingly, in Q1, government is ordering Turkish producers to focus on domestic market and will let only 10% of produced NPK 1515 and NP 2020 to be exported. No other nitrogen fertilizers we will see in the international market, unfortunately. Of course, it will fuel prices for all these products in Europe, which is the main buyer of Turkish products. Another news, which is not really news, but a story which is developing, comes from Yara CEO, who consistently defends tariffs on Russian fertilizers imports to EU. The current proposal that emerged in press is 20% duty on all Russian fertilizers entering EU in order to level the playing field. However, for now, European Commission is considering this proposal, nothing concrete yet. Moving to the fundamentals. European natural gas futures fell to 44 euros per megawatt hour last week, the lowest since December 19, as milder temperatures are expected later this month, increasing gas availability. Temperatures are forecasted to be near or slightly above normal from the weekend onwards. Although storage levels are lower than last year, currently at just under 70% compared to 83% in 2024, the supply situation remains stable. However, price level this year is higher by 50% than a year ago. That clearly negatively influences European fertilizers producers. US natural gas futures jumped to above $3.9 per MMBTU on Friday, driven by forecasts of colder weather and increased heating demand over the next 2 weeks. Meteorologists predict below normal temperatures in much of the US through January 25, with the coldest days yet to come. LNG exports also hit record levels, with feed gas flows climbing to 15.5 billion cubic feet per day, including a surge in flows to the new Plaquemines LNG plant in Texas. Meanwhile, production showed signs of stabilizing as freeze-offs, which disrupt output during cold weather, began to ease. For the week, natural gas prices rose over 17%, recovering after recent declines. Other news from the gas industry that caught my attention came from Egypt. ExxonMobil has made a discovery in its first ever well offshore Egypt. The well result is still being evaluated. Of course, any commercial gas discovery there will be positive news for Cairo and oil majors seeking gas in the Mediterranean offshore, taking into account overwhelming problems with gas supply that country faced in recent years. One more news came from Azerbaijan that stopped gas supply to Serbia on Saturday due to technical problems at its Shah Deniz gas well. Earlier, gas supply to Bulgaria was also suspended. BP Azerbaijan didn't inform about potential timing of problem solving. We will keep an eye on it and see if this situation influences gas supply to producers of southern Europe and thus if gas cost will change for them in the short term. And of course, one of very important news of the week was that the US Treasury on Friday announced sweeping new sanctions against the Russian energy sector, including sanctions on several gas producing companies, LNG producers, and LNG carriers. It will definitely limit opportunities for Russian products to reach its customers worldwide and gain additional financing for its cruel war against Ukraine. Agricultural commodities future prices moved in different directions amid the forecasts in the fresh January report of USDA. Wheat futures remain stable, above $5.3 per bushel. USDA report registered just minor changes in the global supply-demand balance versus December evaluation. Globally, supplies are up by 400,000 tons, driven by increased production in Syria and Pakistan. On the other hand, global consumption is lowered by 600,000 tons, primarily due to reduced demand from Turkey. Global trade is forecasted to decline by 1.7 million tons. Specifically, Russian imports is cut by 1 million tons due to poor harvest results, plus Ukrainian imports also cut by 500,000 tons. At the same time, ending stocks are expected to rise by almost 1 million tons. Corn futures surged above $4.6 per bushel, reaching their highest level in over 7 months, driven by tight global supplies and robust demand. The USDA report indicates a continued contraction in the US corn stocks, with ending stocks forecast to fall for the 7th consecutive month, underscoring sustained demand, particularly from ethanol industry. Globally, corn supplies are the tightest since the 2021 season, with global stocks revised down, as major exporters, including the US, Brazil, Argentina, and Ukraine, face a 13% drop in corn stocks. Moreover, adverse weather conditions in Argentina threaten to further reduce supply, heightening concerns about export availability. Soybean futures surpassed $10.1 per bushel on Friday as investors processed the latest USDA report and ongoing concerns about weather conditions in South America. Globally, soybeans production is forecasted to decline, mainly due to decreased outputs in the US by 2.6 million tons. Global soybean crush is expected to increase, driven by strong demand, particularly from Brazil, while global soybean ending stocks are predicted to drop by 3.5 million tons, primarily due to reduced inventories in the US and Brazil. Speculative funds have turned bullish on corn, moving from near record shorts in 2024 to their largest net long position since February 23, due to strong demand. The market outlook for wheat and soybeans continues to be bearish, although stronger prices for corn could have a supportive influence on wheat later on. Moving to the shipping industry. Containerized freight index dropped at the end of last week by 90 points, or about 4%. However, spot rates for main routes from China to the US climbed by 10 to 15%. In the US, port workers and operators have reached a tentative agreement last Wednesday, averting a looming port strike in January. Nonetheless, market expects rates on the Trans-Pacific trade to rise in the coming week, driven by front-loading ahead of the anticipated tariff hikes under the incoming Trump administration. The Baltic Exchange Dry bulk index advanced for the second successive day on Friday to 1,049 points, amid continued support from the bigger size segment. The Capesize index climbed to its highest level since December 10 last year, mostly due to activity registered in South Brazil, West Africa, and later in the week in the North Atlantic. Conversely, the Panamax index fell by 39 points to its lowest since July 2023 level, with further substantial downward corrections in both basins. Supra Ultramax index shed 11 points, recorded its 13th consecutive day of decreases. Fresh inquiry remained limited, and there was a considerable amount of prompt tonnage which remained open after the holiday season. In Handysize, as anticipated, the first full week of the new year has seen limited activity across both basins, with market sentiment remaining generally subdued. Another shipping-related news came from Australia, where port operator in Brisbane started a week-long strike last Wednesday. It is a result of months-long dispute with Maritime Union of Australia. Some market players anticipate that it may last not 1 week, but at least until March. If it happens so, the situation might impact urea imports, even maybe at big scale. To sum up, price rally in urea continues in 2025. Indian retender that was announced 2 days ago, suspension of Iranian exports for a clear amount of time, seasonal purchases that start to emerge from key buyers in Q1 like Europe, Turkey, and further US and Australia will keep urea prices elevated. Nitrates prices also surge, partially due to increase of gas price in Europe, partially as a response to urea price rally. At the same time, ammonium sulfate prices haven't responded yet, but perhaps will also do so soon. Phosphates price continues to be elevated with no signs of downward correction soon. India's decreased stocks level indicate their need to purchase and produce more in Q1, and Chinese being out of international market limit opportunities to source the product. European gas price cooled down amid warmer weather arrival, and gas price in US, on the contrary, surged due to cold, as well as very healthy LNG export pace. Fresh USDA report resulted in corn and soybean price upward correction, while wheat price remained unchanged due to balanced market. Dry bulk shipping activity remained subdued, perhaps as a result of holiday season, so Baltic Exchange Dry index flows at a historically low level. Cost of container shipment didn't change much and floats around pre-holiday level. So let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.